Now, as we look at what is happening on the housing front, we want to, again, turn to what's happening with the University of Michigan. It's just a way of looking at sentiment in general. So here you can see that the sentiment was stronger in April at 65.7 versus the estimate of 59. Current conditions were up to 68.1 versus the estimate of 67. So expectations up to 64.1 versus the estimate of 53.6. So you're getting a bit better, which is, again, when you look at gasoline and some of the other pricing, you normally have a little bit of a bounce. So here, when you start looking at, we're still below where we were during COVID. And that's something that we think is going to continue to be an overhang when you look at where things are. Not that they're going to continue to get better, but they're just going to kind of stay back and forth in this level. So then when you look at buying conditions for vehicles and homes, it still remains the worst for vehicles. It's the worst ever. And that's going back to 1980. And then when you look for homes, it's the worst it's been since the 1980s as well. So again, still not a very good time to buy any big ticket items, if you will, when you're looking at some of the different pieces in general. And that's going to be an underlying overhang that will be a continuous problem going forward. So then when we start looking at how the pandemic has impacted things, so how the pandemic impacted where we work and where we want to work. So it's not surprising when you look at current work locations, 28% remote, 62% in person, 10% hybrid, and current preference is mostly people who are remote want to stay remote. And a lot of people who are remote want to turn to the hybrid piece. So that in-person comes down, because if people could choose, a lot of them will go into the hybrid, which is the one that we think takes the most market share, which again also eats into kind of that longer-term backdrop on gasoline and diesel pricing. Fewer than half full-time remote workers want to return to the office. And I think that's why there's going to be more of that preferential treatment when you're looking at the hybrid, saying, okay, well, I can't leave you fully remote, but I won't make you come back into the office all the time. We'll come up with some sort of kind of in between, which again is also why people want to have nicer homes. They're going to spend more time in them, have an office, be a bit more spacious. And a lot of that has already happened. And that's when we start looking forward to, well, where is the next kind of that next segment, that next increase, which is some of that overhang. The remote option has become cemented in work culture. And I think that's the biggest piece of it. If we're not going to see that pivot going forward. And I think that's going to be the bigger overhang when you look at how work from home continues to become such a big piece of the market, which is why the expiring office leases in square footage for 2022 is 242.548 million square feet is expiring this point in time. So that pivot is going to hit hard. You're already seeing people doing that, which is why we think there's going to be some of this overhang when you're looking at rent and when you're looking at leasing, because why do I need this office space if half of the employees won't be in the office at different periods of time? Again, leading to some of these overhangs. Now, when we start looking at home sales, March existing home sales came in at negative 2.7% versus the estimate of 4.1%. And it was down, was negative 8.6% in the prior month, revised lower. Monthly supply ticked up from 1.7 to 2. Medium home prices was up 15% year on year, $375,300. It was weak back-to-back monthly declines for sales. This is typically kind of that little bit of a lull. The key is going to be, what does April and May look like? Are we going to start to see that upswing? I think that we're going to continue to see some of these pressure points, especially as rates continue to go up, which again is making it more expensive, and will show what that means in the near term, which is why when you look at home buying, average probability of buying a home if a household move over the next 3 years drops sharply to 60.7% from 68.5% in 2021, making the first decline since the annual housing survey started in 2014. And it's just, again, people are looking at this and saying, I can't afford the down payment. I can't afford, so I'm going to have to rent. Even though rents have also gone up, this is just showing those additional pressure points. Number of housing units authorized but not started has surged to the highest since the 1970s. And that's also leading to, because there's a big problem in terms of this little thing called starts. No sign of reversal yet for housing market tightness. Spread between completions and construction is the most negative in history. So when you have permits, yes, we have the most permits when you think back to the 1970s. So we have the most number of housing authorized. But if I'm struggling to finish and complete, why am I going to start new construction? And that's when you look at it, it's the most negative in history. And unfortunately, this isn't something that's going to change in the near term because supply chain still remains a problem. And this is where we continue to see some of these overhangs. And this is just showing some of that differences. Permits, again, back to the highs, starts continue, but completions are just not there. And that's keeping some of that artificial tightness. But as the completions start to kick back up, you're going to see, again, a bit more supply, and that demand we don't see that coming back as much. So that supply is going to start to pile up, bringing down some of this pricing. Home builder market index slipped in April to 77 versus the estimate of 77. Per chief economist Robert Ditz, housing market faces inflection point as a rise in interest rates, home prices, and material costs has significantly hurt affordability. And if you think about it from a home builder's perspective, your costs are already elevated. So even you're still going to try to at least break even. So how low can you actually go on that house? And again, that's going to also lead to margin, profitability, and those are going to be some of those underlying issues that remain. Housing inventory, April 18th update, inventory was up 3.7% week over week and up 12.3% from the seasonal bottom. And again, we expect that inventory to continue to creep higher, but it normally creeps higher this period and then starts to fall as we go into that spring and summer move. So the question is going to be, do we get that, or do we just see this kind of gradual increase? We expect to see a bit more of a gradual increase. Housing affordability index has moved down to its lowest level since 2008. This is based on February data when mortgage rates were over 1% lower than they are today. The result, current affordability is much lower, plummeting over the last 2 months. So when you look at it, the affordability for home has gotten even worse. And again, it's only going to get even more pressure. Because when you look at the 30-year conforming fixed rate at 5.27%, you're getting an idea of just how expensive mortgages are, interest payments are, which again hits affordability. So that's when you start looking at the home builders index. Then this is in aggregate, had some soft spots in April, but future sales component did bounce to 73 from 70. So there is a little bit of hope that future sales will get better. They typically do. The question is, are we going to see that, or will we see some of that pressure? And then when you look at March housing starts coming in at 0.3% versus the estimate of 1.6%, negative 1.6%. Building permits came in at 0.4 versus negative 2.4% estimate. So you're still seeing housing starts there. You're still seeing permits, but the completions, there's still that backlog of completions. And as that accelerates, that's when you're going to see some of this additional capacity coming on. And this is just showing, going back to the 1970s, just to give you an idea of the amount of new home under construction going back to 87. So a lot of homes under construction, but you need to see them get completed. Inventory of new homes for sale continued to go up. But the problem is, again, that completed side. So as you get a little bit of things getting a bit better on the supply chain, you should see this tick back up. But to be very clear, 16% getting better is still a terrible number given how bad things were. So 61% is still saying they're the same. So again, even though we should see a little bit of an increase, there's still a significant supply chain problem. So again, we're not saying that there's just going to be this huge surge of capacity. We just think it's going to be gradual. But then as things continue to get a bit better, sales slow, that's going to again put some additional capacity on the market. And supply chain concerns moderating in North America. Concerns over supply chains have moderated with nearly all typical topics, but again, there's still a problem. They're still out there. And based on what we talked about in segments 1 and 2, they're going to get worse again based on what's happening in China. Price to income ratios, when you get an idea of the level, when you just look at the price to income, continues to get much worse. National single family rent index at a record level going back to 2005. Low-end rental prices were up 12.7% compared to high-end prices gains at 12.8%. So again, still very expensive to rent a home. Now, eviction filings have started to increase. They're not back to 100%, but as the moratorium expired, you're starting to see that accelerate. And as that accelerates, again, you're going to see more capacity come on because these homes and these apartments will need to be filled. All the while, when we look at the Freddie Mac U.S. mortgage rate, you can see that it is already going past year on year over 2%. So the surge in mortgage rates continues unabated. The 30-year average rate has increased over past year at the fastest pace since the early to mid 1990s. And that's not something that we see stopping based on everything that we talked about in segment 2. So again, these are the pressure points that we're seeing. These are the reasons why we continue to see a lot of these elevated levels. But now that we've gone through some of this and the pressure points on pricing, home pricing, why we think it'll come a bit lower, we need to look at Europe and some of the newer data that has come out. It's a bit light. It'll be a short segment, but something that I think is important to cover before we go into the Asian markets.